Hello everyone, and welcome to the Graphs channel. Today, we'll talk about one of the most well-known and powerful reversal patterns in technical analysis, the head and shoulders, also known as the H and S pattern. You might have come across it many times while looking at charts but never fully understood how it works or what it really means. That's exactly why this video is so important, especially for traders trying to identify trend reversals, because the head and shoulders is not just a shape, it's a story about the balance of power in the market. If you're ready, let's dive into the details after the intro. The H and S pattern consists of three main parts. First, the left shoulder, the price rises, then pulls back a little. Then comes the head, the price rises again, and forms a higher peak. Finally, the right shoulder, the price tries to rise again, but isn't as strong as before, forming a lower peak. This three-part structure tells us one thing: buyers are losing strength and sellers are gaining control. The most important part of the pattern is the neckline. You draw it by connecting the low points of the left shoulder and the head. If the price falls below this line, meaning the support is broken, the pattern is confirmed. That's why many traders don't enter a trade early. They wait for the neckline break, because until that happens, the H and S is just a possibility. Now let's look at a real stock chart example. Suppose a stock rises from $100 to $150. Then it drops slightly to $120, that's the bottom of the left shoulder. It rises again to $180, that's the head. Then it falls back to $120 once more. Next, it rises again to $155, but fails to break $180, that's the right shoulder. Now we have a complete H and S pattern. The neckline is at $120. If the price breaks below $120, the pattern is activated. The target is the distance between the head and the neckline. $180 minus $120 equals $60. That distance is projected downward. $120 minus $60 equals $60 target level. Of course, this isn't guaranteed, but it's the standard measurement method in technical analysis. Now let's talk about not only the classic H and S, but also the different variations you might encounter in real markets. Because not every H and S you see on charts will look like the perfect textbook example. Often they appear tilted, asymmetric, or irregular. One of the most common types is the classic H and S, where the left shoulder, head, and right shoulder are clearly visible. The neckline is flat, and when it breaks, the price usually drops sharply. This is the version most often shown in technical analysis books. Another type is the H and S with a sloping neckline. Here, the neckline isn't straight, it slopes either upward or downward. An upward sloping neckline is generally less reliable but can still signal a strong drop. A downward sloping neckline indicates that sellers have already taken control, and the breakout could lead to a sharper decline. Sometimes you'll see asymmetry, the left shoulder may be smaller, the right shoulder larger, or the head much taller than the others. Even so, the pattern remains valid. What matters is understanding the logic behind the shoulders and the head. There's also the failed H and S, where the price looks like it's about to break the neckline, but then quickly reverses. This is called a fakeout. It often appears on smaller time frames and tends to trigger stop losses. That's why risk management is crucial when trading the H and S. Not every breakout is real. In short, the head and shoulders can appear in many variations. What matters isn't a perfect shape, but understanding the psychology behind it. So how do you trade it? The classic approach is to open a short position when the neckline breaks. But some traders wait for a retest when the price breaks the neckline and then pulls back to test it again. Entering after this test is often safer. A stop loss is placed just above the right shoulder, keeping the risk limited. To sum up, the head and shoulders is one of the strongest patterns for identifying trend reversals in the market. But as I always say, no pattern is 100% guaranteed. That's why it must always be used with proper risk management. Let's recap. The H and S consists of three peaks: the left shoulder, head, and right shoulder. The pattern is confirmed when the neckline breaks. The target is calculated by projecting the distance between the head and neckline downward. If volume decreases during formation and rises during the breakout, the reliability increases. Psychologically, it shows that buyers are exhausted and sellers are taking control. However, beware of false patterns and always use a stop loss. The head and shoulders is not just a chart shape, it's a powerful indicator of market balance, strength shifts, and the battle between buyers and sellers. If you enjoyed the video, don't forget to like and subscribe to the channel. See you in the next one.